with these 2 hours exclusively for this particular session. So this shows your professional commitment, and my I express my sincere thanks to each one of you for doing that. And now, actually, as Kajal Madam informed us, today's topic is on income approach. So, what I have lined up, actually, a practical aspect we will go through first, because ultimately, income approach that is related to the projections. And if our projections are not correct according to the laid down statistical procedures, so we may end up actually having means not a correct projection, and that will ultimately affect the overall estimation of the value. So we will go to my Excel sheet first. So with that brief introduction, I will share my Excel sheet. So just give me a minute. So I hope my this Excel sheet is visible to each one of you. And if you have any issue in visibility of my Excel sheet, you may inform me anytime so that we can correct that. And we all are a professional. We all are experienced professional. You actually are knowledgeable also. So make this session as a knowledge sharing session. So in the middle of the session, if you need to share your experience on this particular topic, so you all are invited for that. You are free to do that. And along with that, if you have any query on whatever we will cover today, so you are welcome to ask your question anytime, so that this session becomes interactive. So what I have done actually, means I have taken out is a 6-year financial statement data, as you can see, and this data is one of the listed company. So listed company data, getting the listed company data, that is not a difficult task. You can very well get from the website of that particular company, or from the stock exchanges where they listed. So that will provide us a very good opportunity for practice for arriving at the projection. So what I have done, I have taken this 6-year financial statement of Gujarat Gas Limited, which is a listed entity. So that is from financial year 2017-18 right up to financial year 2023. So that is at end of March 2023. So that is actually, as you can see, I have taken this income statement, balance sheet, and followed by the cash flow statement. Cash flow statement I have taken only for 2 years, not for 3 years. So not for 6 years. So that we can get an idea. Now, these financial statement which we get from the annual report or from the annual financial results of the company, these are in the form of form which are prescribed under the Companies Act. So this format may not help us in our valuation exercise. So it is necessary to make analysis of that which will help us in valuation. So what I have done, I have taken this analysis. So first I have taken this means rearrange the items of the income statement in order to give us convenience in the evaluation. So as you can see, it is starting with the revenue from operation, and 2018 the company revenue was around 6,340 crore rupees, which has gone up to 17,306 crores in 2023. So continuously it is expanding, and this will give us idea, this will give us insight to make projections of this company relating to the projections. So after that, I have taken a cost of goods sold and followed by gross profit. So gross profit also increasing from around 1,660 crore in 2018, going up to 4032 crores in 2023. And then we have EBITDA, earning before interest, tax, depreciation, and amortization. So that is 930 crore rupees in 2018, going up to around 2,500 crores in 2023. And then we have a profit before tax, tax expenses, and a net income. So net income also going up from around 290 crore in 2018, right up to 1,525 crore in 2023. So that will exactly match with this raw data. As we can see, it is 291 and 1525.47. Then we have this balance sheet. So balance sheet, no major changes are required. A format, same format will be helpful in our evaluation also. So asset side, we have a non-current asset, and as we can see, a non-current asset of this company has gone up from around 6,000 crore to around 9,000 crore in 2023. And then we have current assets of this company. So that is around 700 crore in 2018, going up to around 2,000 crores in 2023. So we have this total asset and equity, as we can see, that was around 1,850 crore in 2018, going up to around 7,000 crore in 2023. So that will show how profitable this company is. That will actually, as we can see, there is no change in equity share capital. But may I request each one of you to please mute whenever you are not talking. You have question. If you have question, so you can ask anytime. But interim period, my sincere request to each one of you, please mute yourself. So a total equity that is around 1,850 and going up to around 7,000 crores in 2023, largely due to increase profitability or increase in reserves or increase in other equity of the company. Then we have this non-current liability. So non-current liability that is on a decreasing trend. So that is that we need to decide whether the decreasing trend in non-current liability, that is as per operational requirement or otherwise at a decision we need to take. So a non-current liability that was around 3,291 crore and going down up to 1,000 crore, roughly 1,100 crore in 2023. Then we have this current liability. So current liability has a double 100% increase between 2018 and 2023. So again, decision needs to be taken by the valuer, whether that is as per the operational requirement or otherwise. So that is around 1,500 crore in 18, going up to around 2,800. Now, based on this, we can do many analysis. This data will be helpful in making a projection. So that before making a projection, we need to do the analysis of different types. So we will start with the vertical analysis of the financial statement. So in a USA, whichever a company is listed, so there is a requirement to actually incorporate vertical analysis of the financial statement along with the financial statement which are filed with the stock exchanges, so that it is becoming a public document. In India, we do not have that practice, and this vertical analysis that will provide a very good insight if we compare the result of this company with the other company which are operating in the same industry or in a same sector or even intersection, means companies operating in other sectors. So vertical analysis is a very important, and we call it as a common size analysis also. So this is in a percentage term, as you can see. Vertical analysis is always done in a percentage terms. So when it is a percentage term, it will be very easy to compare each element of a financial statement with the other company. That is how it is known as common size analysis. Common size of financial statement or a common size means analysis. So that will give us some common factor. So as you can see in income statement, the revenue from operation that is taking at 100%, that is our threshold. So all other elements of the income approach that will be compared with reference to the income from operation. So that is very important. So as you can see, the cost of goods sold of this particular company, that is around 74% in 2000. Any questions? So that cost of goods sold, that was around 74% in 2018, and that is around the same percentage, varying this 80% in 2022. So as we are aware, this 21 22 that was actually affected due to the pandemic condition, due to the nationwide lockdown. And after that, in 21 22, industry started operating. So demands may have gone up. And the prices of crude oil, as we all are aware, that had also gone up in this particular period. So we, India, import around 86 to 87% of our energy requirement. So we are actually largely dependent on the global market. So if a increase in crude oil prices is there, that will affect all the companies which are operating in the petroleum sector. So because of that, this is abnormal, but bearing that, as you can see, the cost of goods sold is around 75%. So that will give us good insight to make a projection of a future. So we can very well take a cost of goods sold at around 75% of the revenue from operations. So that will provide us the gross profit, the revenue from operation less cost of goods sold, that will give us the gross profit. And then employee cost. So as you can see, employee cost is continuously decreasing. So that is a worrying factor. The importance of machine is increasing and importance of man is decreasing. That is the trend. We all are aware. We are living in the era of automation. We are living in the era of artificial intelligence. So most of the processes of the companies nowadays are getting automated, and because of that, the requirement of manpower is decreasing. So that will also give us a good insight for making a projection.
Sir,
Yeah. Please go ahead, sir. Any questions? So it seems it was by mistake. We will continue. This will give us the EBITDA margin, earning before interest, tax, depreciation, and amortization. So as we can see, that was around means 14%, bearing this 20% in 2021, which was again a pandemic year. So that we can that will be helpful helpful to us in making a projection. And then we have profit before tax. So profit before tax is between around 5% in 2019, going up to 15% in 2021. That was due to the pandemic. So this will actually highlight the need for a normalization of this historical financial statement, figures appearing in the historical financial statement, because some abnormality will always be there in the historical result, and that needs to be corrected. So that is a profit before tax. And then we have a tax expenses of around 2% of the revenue from operation, and that will provide us the net income, which is again around 4% to 7%, bearing this 2021 figure when it was around 11%. So that is the analysis of the income statement, a vertical analysis. A balance sheet, asset side, total asset is a threshold that we need to take as 100%. So that will provide us the figures. So as we can see, property, plant, and equipment, that is also continuously decreasing. So that will actually give us further insight how automation is even decreasing the requirement of plant and machinery. So that is around 72% in 2018, going down up to 60% in 2023. So that is about the plant and machinery, which is a major components in a non-current asset. And as we can see, non-current asset that was around 90% in 2018, going down to around 82%, so 8% a decrease. All these numbers will actually greatly help in making a projections. And then we have this equity and liability side. So equity and liability side, as we can see, total equity that was around 28% in 2018, and that has gone up to around 64% in 2023. So profitability, because of profitability, and the total non-current liability that was around 50%, and that is a decrease to 10%. So in absolute figures, in numbers that may not give us a correct idea, if we convert it to percentage, we can so see that from a 50% of the total equity and liability in 2018, the total non-current liability has come down to just 10% in 2023. So that will also provide us food for a thought for making projections. And then we have this current liability, which is around same percentage at 23%, 27, and again at 26%. So current means current liability, there is no sizable change. There is no actually means noticeable change, but that is not true with regard to the total non-current liability. So that will give us the vertical analysis. Now we will move to the historical analysis of the financial statement. So historical analysis of the financial statement, how it is done. So a figure of current year that is compared with the some base year. So base year we can take a previous year also, we can take it as a base year, or we can take any other year as the base year if that is as per our analysis of the historical statement. So here what I have done, I have taken the previous year as the base year, and the vertical analysis can only be done in a percentage terms. As we all are aware, historical analysis can be done in a both way, absolute number and in a percentage terms. So in 2019, as we can see, there is an increase of 1,623 crore in revenue from operation as compared to a previous year. So a previous year, that is 2018, it was around 6,300 crore, and that has gone up to around 8,000 crore. So that is registering an increase of around 1,623 crore, and in a percentage terms, it is a 25%. So like that, we can do for all other element. And as we can see, net profit has gone up from around 125 crore in 2019 as compared to 2018. And there is a significant jump in a percentage term. So percentage term increase in a net profit is around 43% as compared to its previous year. So like that, we can do this horizontal analysis for all the years. We just, I have compared the means, as you can see, I have compared the figures of current year with a previous year with reference to a percentage term, and we can do that in absolute terms also. So that is about income statement. And then we can make this horizontal analysis of the balance sheet also. So as you can see, somewhere it is abnormal, 8,200 crore increase. So that we need to correct as compared to a previous year. So this horizontal analysis also give us a very good opportunity for making analysis. As you can see here, it is around 400 crore. So straight away we can make analysis of that and correct the projections. So that is the vertical analysis of the financial statement. Now the third method is moving average. So moving average we can do with means for entire period of 6 years, or we can arrive at moving average at 2-year interval, 3-year interval, 4-year interval as we deem fit. So here I have done for a 6-year period. So as you can see, moving average is nothing but average of revenue. So the average revenue will also provide us a good opportunity for making up analysis. So as we can see, revenue from operation is around 11,500 crore on an average. And as we can see, the net income is around 996 crore. So that will on an average between 2018 and 2023. So that will also give us a very good opportunity. Now, this is a compounded average growth rate. So compounded average growth rate will also provide us a very good opportunity for making projection. So this means how it is arrived. So 2018, as we can see, that was around 6,300 crore, which has gone up to around 17,000 crore in 2023. So that gives us that is revenue from operation that has increased by around 22.25% annually compoundable. So that we can a conclusion we can draw. So that if we want, we can compare this also. So we will start with year 0, and then we have this year 1 to 5. So just give me a minute. We will actually compare this so that it is more. So if we will start with year 0 and 1, 2, 3, 4, and 5. So this year 0 is nothing but 2018 we can make, and then we have 2019, and we can go up to 2023. So now in 2018, our revenue from operation that was we will take from here only. So that is around 6,340 crores, and that is going up by 22.25% annually. So that is this 6,339 crore multiplied by 1 plus this compounded average growth rate. So that will give us of 2019, and we will convert this in a number format so that it is more easy. So and this compounded average growth rate that will not change. So we will log that, and that will provide us 23. So that will give us these results. So in 23, as we can see, it is 17,306.16, which is exactly same 17,306.16. So we can make a conclusion here that the revenue from operation that has gone up by 22.25% annually compoundable basis. So that is a compounded average growth rate. So as you can see, that will also provide us a very good opportunity for making analysis. So that is a compounded average growth rate, and this is a weightage moving average. So what is weightage moving average? So as we all are aware, the chances of repetition of 2023 figures in 2024, that is more as compared to chances of repetition of 2018 figure in 2024. So what we can do, we can assign higher weight to the latest year, and we can assign less weight to the previous years. So that will also give us a very good source for making a projection. So as you can see, I have assigned a 29% weight in 2023, 24% in 2022, followed by 19, 14, 10, and 5% to the figures of 2021 until 2018. So that actually this I have given an hypothetical manner, random basis. We can do that based on whatever information available with us. So we can increase the weight of latest year and decrease the weight of previous year. So that will provide us the weightage moving average, and that is a very good source of information. As you can see, that is a formula driven, and that I have worked out for all the years. So that is the weightage moving average. So so far actually we have actually gone through the vertical analysis of the balance sheet, of financial statement, income statement, and balance sheet. We have done the horizontal analysis. We have done the moving average. We have done the compounded average growth rate. We have also done the weighted moving average. Now, what we can do, Excel, we can make use for a projection. So Excel itself will provide us a projection, estimated a projection, if we make the correct use of that. So I will take you to there actually. So, actually, there are various sources available. So we will start with actually in a data. We have this forecast sheet. If I am not aware whether you are aware about this or not, but this forecast sheet will also give us a very good projection. So directly it can provide us the projection. So what I have done for that, instead of annual figure of Gujarat case, I have taken this quarterly number. So if we have monthly number, if we have a daily number, that will provide us more accurate projection. Actually, projection you can widen as far as long as you can. So if you have the correct data available with you. So what I have done, I have taken this quarterly results of this particular company, and I have taken just one element, that is actual revenue. It is not easy to take all the element, so that I have taken the actual revenue figure on a quarterly basis. So as you can see, starting with the first quarter of financial year 15-16, I have taken this till 2022. So what we need to do, whatever these actual results are there. So actual results, as you can see, I have highlighted in a blue set. So I am just highlighting these figures starting with the first quarter of 15-16 till the March 2022. Rest all of the thing Excel will do for us. So just we have to click this forecast results, forecast sheet, and that will actually take us to this dialog box. So here we can make adjustment. So here it is showing me a forecast and a date as 31st of March 2023. So 31st of December 2023. So I am having a figures until 31st of March 2022, and I need a figures actually till the 5 years. So what I can do, I can change this until 2027. So that adjustment I can make here. So 2027 right up to 2027, I will click that, and that will give me projections till 31st of March 2023, 2027. And we have these options. So this is starting my projections from 31st of March 2022. I have actual number of 2022, 2023 also. So once I get projection, at least of 1 year, I will compare with actual figure. That will give me idea whether I am going in a right direction or not by taking help of this. So that is a forecast start period, and confidence level that I am showing at 95%. So since these are my actual result and it is a listed entity, so more or less a listed entity, I am sure that whatever figures I am having, actual results, historical statement I am having, that will present me a correct picture. So I am taking this confidence level at 95%, but depending upon the projections of historical results which we have, we can change this confidence level. And these actually Excel, even if we do not have the actual figures of intermittent period. So supposing we do not have actual results of some quarters in the past, so that Excel will take care. So up to 30% Excel can take it, so take care of. So that is the maximum limit. So even if we do not have actual results of around 30%, Excel will provide us the projection. And this is detect automatically, that is about the seasonality. So we can actually set the seasonality as we can see. So if a business is doing good business only in a Diwali time, so we can adjust this seasonality indicator accordingly, annual. If it is a quarterly, we can adjust this. But if we don't do anything, and Excel will detect automatically, and that will provide us. So by default, it is automatically, but based on a result, based on the figures or information which we can have, that will provide us opportunity to set this result, set this manually. So that will give us, and once we click this create tab, so that will create entire projection for us, as we can see, that is giving us a separate sheet. So that is highlighting my 2015 figure till actual results till 31st of March 2022, and that is also providing me with this projected figures, and that is for next 5 years that I have set, and that is also providing me this a graph also. So graph I can change in a manner I want. What I will do, I will highlight before you the actual result. So actual result of last year we already have. This is the actual numbers. So I will copy this. So if I copy this, and that will provide us a good idea. So that is around 5,300 in 2022. That is around 5,300 crores. So that is giving us means 2022. That is giving me a 3,800, a 4,800, and a 5,900. So three values it is giving me: forecast, lower confidence bound, and upper confidence bound. So this figure, actual figure, more or less it will be in these three range. So this here three range we can have from 3,800 to 5,900, and we can also have this 4,800 to 5,900 range, the base and the upper limit. So that will provide us a very good opportunity, as you can see. So a total of these 4 quarter actual, that is around 20,000 crore. And if I see actual, so that is around 17,000 crore. So that adjustment or judgment when you are need to do, more or less it will be in a same range. So that is the one way of doing the projection. And there are other methods also, so that we will see. So this is the my forecast linear. So based on that also I can make use in Excel. There are many forecast figure. So I am just reflecting here. I am recalculating this here for a convenience. So that is a forecast, and we have this function for a forecast. So this forecast linear function that is used more. So that will actually provide us help also, that I want to show. So what is that? That calculates or predicts a future value along a linear trend by using the existing value. So that is the function of this particular function. So that is the use of that particular function. So forecast linear, and we have to first enter the x. So x is our period. So I am taking that period as 30th June 2022, and a non-wise. So non-wise are my actual revenue. So that I am taking here. And then I need to give the non-X. So non-X is my X is my period. So once I give that, so that will provide me the forecasted figure. So that is 3,770, and that is March 2022. So that will give me for all the years. So that is one way of arriving a forecast ETS, a forecast linear. And then we have a forecast ETS function. So what is a forecast ETS function? So that will provide me a forecast ETS. So that returns the forecasted value for a specific future target date using exponential smoothing method. So this will provide the exponential smoothing method. all these are functions in statistics, and it is not possible to go through or explain all these function in a 2 hour. Actually, in Excel itself, that will provide us the help, and with that, actually, we can learn many things. So here, if we click that, so I will show you how to do that. So first, it is a target date. So my target date is this 30th June 2022. Then the values. So values is my actual values. So that I will select this, and then it is giving me that Excel is prompting me to give the timeline. So this is my timeline, and then we can close this, and we can have this. So that is a 4877. So that is we can get like this for all the future period, and we can get help from that. So this is the function, and here we can that will show me the result, and here is the help on this function. So once I click this, it will take me to the help portion, and that will give me a very good insight about this particular function. So that is the this forecast ETS function. Then a similar way we have this forecast ETS conflict function. So that is another way of arriving at the numbers. So that is returns a confidence interval for the forecast value at the specified target date. So that also we can do. I have done this, and then we can have this moving average also. So a moving average in a data tab, we have this various function. So data analysis. So once we go to this data analysis, so that will give us the many types of analysis which Excel is doing. So right now we are interested in a moving average. So a moving average, just I click that, and if I give the input range, and if I give the interval and output range, so that will provide me with this moving average. So here, as you can see, I have arrived at this 3 period moving average. So that is nothing but this is a 3 period moving average. So average of these 3 period, and it is moving. So that is give us a moving average for a period of 3 months. So that is another way of arriving at the projection. So now we will go to the ratio analysis. So if we have historical number, we can do many type of ratio analysis. So we can have this liquidity ratio, capital structure ratio, coverage ratio, profitability ratio, expense ratio, activity ratio, asset turnover ratio, a return on investment, and a DuPont framework. So all this type of ratio analysis that will be actually once we have a figure, so that will become easy. We can make use of historical number to arrive at various types of ratio, and particularly this DuPont framework, that is very important, that is available for a 3-stage analysis and a 4-stage analysis. So depending upon our requirement, we can do that. So that is about the ratio analysis. And now we have this data visualization. So data visualization, actually, as we all are aware, that is becoming a very popular. And through a data visualization, we can have a very good insight about the past history. So here I have done for a 2 period, a gross profit versus net profit, and a revenue versus a cost of goods sold. But we can do many such data visualization, and that is very easy once we have these figures. So supposing I am making use of this revenue from operation, it is not there here. So gross profit and net profit, revenue versus cost of goods sold. So we can do the data visualization for revenue versus a net profit. So that is just we need to select this, and that Excel will do the rest. So what I am doing, I am selecting this. So this is my year, and then this is my period. So sorry. So I have selected a 3-year revenue from operation and the net profit. And if I go to this insert, and that will give me a recommended chart. So from that, I can select any of chart. Supposing I am selecting this particular chart, so that will provide me this data visualization, and I will actually I will take this here. So there's chart title and all I can give. So this is my revenue, and this is my net profit. Revenue from operations and net profit. So that will give chart. We can have many types. Any types we can do. So that is about the data visualization function. And now we will go to this weightage average cost of capital. So we will start with this perpetual growth rate. So in the DCF, or in income approach, the ascertainment or projecting the terminal growth rate, that is of vital importance, because as we all are aware, the terminal value, that is around 75 to 80%, perhaps more than that in many cases. So that value is coming from the terminal value. So estimation of the terminal value, or the projections of the terminal value, that is of vital importance. So that is and as per the guidance provided in the international valuation standard, the terminal growth rate of a company, that cannot be more than the growth rate of the economy in which that company is operating. So meaning thereby, in India, the companies cannot have a terminal growth rate more than the GDP growth rate of India. So that is the bottom line. That is the guidance provided even in international evaluation standard. And going by the findings of a recent survey also, in India, normally companies are taking the growth rate of around 4%. So that is within the benchmark. So what I have done, I have taken this perpetual means GDP growth rate from the website of World Bank. So World Bank will always provide us the reliable figure. So in that, if we visit the website of World Bank, so that is giving us the growth rate, GDP growth rate of all the companies in the world, so that we can get very conveniently. So I have taken from 2012 to 2022. So that is a period of 11 years. So we can see the average GDP growth rate, that is around 5.70%. So means we can very well say the average growth rate of India between 2012 to 2022, that is around 5.7%. So that is the upper limit for a terminal growth rate, and the terminal growth rate of any company, that cannot be more than the but this means GDP growth rate, average GDP growth rate of the country. So what data set is there at right side? Yes, sir, we are coming to that, sir. Datta, sir, we will come to that. So that is the perpetual growth rate. And now actually this is the market return. So it is very important because as we all are aware, there are many methods of arriving at the cost of equity of a company. And one of the largely accepted method, that is the CAPM, capital asset pricing method, in USA, in European country. The CAPM, or a capital asset pricing model, that is used very widely. So for that, we need to have a market return because as we all are aware, the formula of arriving at the cost of equity by a CAPM, that is the risk-free rate plus beta into the equity risk premium. So to arrive at the equity risk premium, we need to have a market return. So here actually what I have done, I have taken the Nifty 50 closing index. So not right from 2012 till 2023. So that is the Nifty 50 closing index, as we can see. So that 31st March 2012, that was around 5,296, which has gone up to around 19,749 on 18th July 2023. So just a few days back, it was around 19,749. That was the closing index of Nifty 50. So that is actually give us the compounded average growth rate in a Nifty 50. So for that, first I need to have this number of years. So a number of years, since it is in a fraction, this means 23, 24 year, that is not complete, that I am taking till 18th of July. So I am making a use of this year fraction function in Excel to arrive at the correct number of years. So that is 11.30 years. And the compounded average growth rate of Nifty 50, that is around 22.35%. So we can very well say the return in a Nifty means shares, Nifty equity share, a Nifty 50 equity share, that is around 12.35% on an annual basis, a compoundable. So that we can draw the conclusion. And this we can again check, but we will not go. We can cross tally this also. So that will take just 1 minute. So that is 5296. It is the 0, and then we have this 1 plus 11.30. So that will give me this figure. Sorry, that is 12.35. I have taken the wrong figure. So that is around 5,900, and this K48 will remain a constant. So that will give me the correct figure of last year. That is 19,749. So that is that we can cross tally also in a same manner. And then we have this 12.35% annual compounded growth rate. And then we have this means what I have done, we need to have a beta. So beta is a very important because in CAPM we also have the beta value. So what is beta? We all are aware. A beta is nothing but a systematic measure of systematic risk. So as we all are aware, we come across two types of risk. One is a systematic risk, and another is unsystematic risk. So measure of systematic risk, that is a beta, and a measure of unsystematic risk, that is alpha. So in arriving at the cost of equity, or in to arrive at the cost of capital, we need to have two types of risk measure, alpha and beta. So for a listed company to arrive at the beta, that is very easy, that is a formula driven. So what I have done, I have taken this closing price of Gujarat case. Since it is a listed entity, I can very well get that easily. So as you can see, I have taken this closing price of Gujarat case for a period of 5 years. So that is from 2023 right till 2018. So as you can see, that is up to 19/7/2018, right up to 18/7/2023. Similarly, I have taken this Nifty 50 figures of this means same period, 5 years. So once I am having this figure, so I can easily have the beta. So that is nothing but in Excel, it is a slope function. So with the aid of slope function, I can very well arrive at the beta. So I have just selected this Gujarat case and the this Nifty 50 figures, closing index, closing price of Gujarat case, and a closing index of a Nifty 50, and a concern a function is a slope. So that is giving me a value of 0.05. So if this value is less than 1, so we can make interpretation that this particular share price volatility in this particular share is less than the volatility in the market, overall index in the market. So we can say if there is a 1% increase or a decrease in a Nifty 50. So this share on an average will react just by 0.05. So that is the conclusion we can do. If it is means less than one, this beta value, so that is less volatile as compared to overall market. If it is more than one, then it is more volatile as compared to overall market. So that we can do the conclusion. So we have now a beta, and now we can have this risk-free rate. So risk-free rate I have taken as a 10-year government of India bond. So government long-term GSEC or a government of India bond, that is considered to be risk-free. So as we all are aware, till last year, actually only historically, not till last year, historically actually banks and financial institution, they were only investing in the government security. They were the investors in the government security. And as we all are aware, government is the biggest borrower from the debt market. Every week, government borrow money. This Reserve Bank of India, as we all are aware, that is the bankers of central government and the state government. So the banks and financial institution, they were historically investing in government security, but effective from last year onwards, we the retail investor, we can also invest in the government security, both treasury bond and the government bond. So a long-term government bond, which can be 5-year, 10-year, 20-year, 25-year, 30-year, or even a 30-year plus government issues the bond. So these government bonds come with the sovereign security, security. Sovereign guarantee. So bank can fail, company can fail, but there are less chances or a negligible chances of failing entire government or entire country. So that will provide us the risk-free rate. So I have taken this once actually for investing in government security, we need to have account with the Reserve Bank of India. And once we open the account with the Reserve Bank of India, then every week we will get that, and the rate of interest is very good as compared to the rate of interest which we get on a fixed what you call a fixed deposit of a bank. So that is a very good opportunity for us, particularly the retired person like me. That is providing a very good opportunity for making investment. So that is a risk-free rate of 7.05 percentage. And so with that, we have all the element of CAPM. So we can easily arrive at a cost of equity. So that is a risk-free rate of 7.05, and a market risk premium, that is nothing but this 12.35 minus this means is what you call means market equity market risk premium is nothing but your equity market return minus the risk-free rate. So we are having this 7.25. So once we have this is CAPM, risk-free rate plus a beta into equity risk premium. So that will provide us the 7.41 as a cost of equity of this company. And this we can take a value of equity, we can take capital structure that we can take from the annual statement of this particular company. And this company is not having any debt, as we have seen in the analysis also. So that is providing a capital structure totally of equity share, and that is my weightage average cost of capital, that is equal to my cost of equity only. So that is the analysis. So that actually I have given a sufficient clue in on making a projection. So we have gone through the means vertical analysis, we have gone through the historical analysis, we have gone through the moving average, we have gone through the weightage average, moving average, we have gone through the compounded average growth rate, we have gone through the ratio analysis, we have gone through the data visualization, we have gone through the various techniques of forecast which are available in the Excel. So that we have done. So I hope this will be useful. And now what I will do, I will present you with a financial model financial model of a company, because as you all are aware, to be on lighter side, it is said in our personal life that a man is incomplete without a woman. So that we say frequently. So in the same way, our DCF is incomplete without a financial modeling. So financial modeling are very important in making estimation of a value going by income approach. So what I will do, I will present you with a financial model, and then we will move to my PPT. We will have a certain theoretical portion also. So just give me a minute. I will come back with my financial model in just 1 minute. So we will start with this cover page. As we all are aware, in any financial model, a cover page is very important. So in this cover page, this particular financial model, that is with reference to the Gujarat case. So what I have done, I have written a brief about this company. So Gujarat case, as we all are aware, that is one of the leading player in city gas distribution. So that is majorly a city gas distribution company. But apart from that, this company is also having a natural gas pipeline. And this company is also involved in a sale of CNG for automobile. So that is the brief about this company. That is actually provide us a brief about this company. And then we have this raw data. So raw data I just explained you, and then we can make this assumption. Now actually assumption is where the skill of valuer is required, a judgment of valuer will require, subjectivity in evaluation will come. So there can be many methods of making a forecast approach is assumption. So based on assumption only our income statement will our estimated value can be arrived at. So what I have done, I have taken this historical number, and based on that, I have made this assumption in a three scenario. So in income approach, scenario analysis and sensitivity analysis, that will play a very important role. Sensitivity analysis and the scenario analysis. Always it may not happen that whatever projection we make in one scenario, that will hold good in all the scenario. So what I have done, I have taken this projection in three different scenario. So that is a base case and a bull case and the bear case. So these are three different scenario. In a bull case, it is slightly higher than a base case, and a bear case, it is a slightly lower than the base case. So that is a three projection. I have done this randomly. So what I have taken revenue from operation, I have taken this average of 1920 because these 21 and 22 figures are not normal. So there can be n number of method for making projection. This is actually, I do not have this I have done for just knowledge sharing purpose. So I am not having any inputs from the management. So once I do not have any inputs from the management, I have done this on a random basis. So that, as you can see, I have taken this revenue growth rate and all other projection, and I have arrived at this inventory days, account receivable days, and accounts payable days. So based on that, I have made this projection. And then I have taken this projection here. So this is a data validation. So data validation is a very important. We can project all three scenarios in one set. So I have taken this base case. Then we can have this bull case, and we can. If I make this bull case, all figures will undergo change, and then we can have this bear case. So all these figure will change automatically. So then a base case, I have taken this from the previous slide. This is the formula for arriving at the for taking a previous seat figure here. So that is in all three scenario, I have to make this formula, and that is giving me the forecast data. And then, as you can see, I am having this income statement, historical income statement, 18 to 2022. And then I have this forecast financial statement for a period of next 5 years, starting with 2023, ending at 2027. So that is my balance sheet. And then I am having this income statement. I am having this balance sheet, and then I am having this cash flow statement, and then after a cash flow statement I can have this working capital schedule, a supporting schedule I will need. So this is my working capital schedule. This is a property plant and equipment schedule. This is a debt schedule, and this is the finance cost. And then I can have this DCF valuation for 2023 to 2027. So that is earning before interest and tax, less taxes, no PAT. So that is my net operating income after tax. So that will give me net operating income after tax. And then I am having add a depreciation, changes in working capital, changes in capex. So whatever my capital expenditure that I have taken. And then I am having this net this a free cash flow to farm, FCFF, and a net cash flow to a farm. So I have added a terminal value here. So terminal value, I have taken terminal growth rate or a perpetual growth rate at 1% only, because I am not having all the figure. So based on that, I am arrived at this terminal value. Then a number of shares I have taken from the capital schedule of this particular company, and a discounting rate, a weightage average cost of capital I have taken, and current share price, that was the price prevailing on when I had done this particular analysis. And based on that, I have arrived at this means enterprise value. Then add cash less debt, that will give me the equity value. And based on that, I have arrived at the intrinsic value of 571. On that particular day, 463 was the prevailing value in the market. So estimated value and prevailing market value, always there will be a difference. So based on this difference, we can further correct our estimation. This is again in a base case. So we will see the value estimation in all three scenarios. So just give me a minute.
You are on mute, sir.
So since when I was mute, I actually thank you for pointing out that. Actually, these different prices I have explained. So once again, I will explain this. So as we can see in a base case, we have this price estimation, intrinsic value estimation at 571. So if I change this to a bull case, this a bear case, lower side, so it is giving me a 526. So that is as means near to the market value. And if I am changing this to a bull case, so that is giving me a 688. So I can have all three scenario prices. And once I am having this analysis, what I can do, I can do the sensitivity analysis. So as I informed you, means this scenario analysis and sensitivity analysis, these are two very important. So sensitivity analysis, we can make use of this data tab, and in a data tab, we have this what if analysis. And what if analysis, we have these three important function: scenario manager, that is your scenario analysis, and a goal seek function, so that will give us the value we want, and then a data table. So data table is a very important for making the sensitivity analysis. Just one click and it will provide us the values. So as we all are aware, in a DCF, there are a certain important variable, and a minor change in one of the important variable will make a very huge difference in overall value estimation. So what I have taken this weightage average cost of capital, which is one of the important variable for this sensitivity analysis. And simultaneously, I have also taken this terminal growth rate. A terminal growth rate, as we are aware, that is also one of the very important analysis. So with that, actually, what I have done, I have taken this sensitivity analysis with the data table. So this base case, this is my estimated value, intrinsic value that I have taken here. And then if my weightage average cost of capital, which I have taken here at 9.46%, but if it is a 10 percentage, 11 percentage, 12 percentage, 13 percentage, or 14 percentage, or my terminal growth rate, which was I have taken at 1%. So if it is a 0 to 5%, 0%, a 1%, a 2%, 3%, 4%, and a 5%. So what will be the corresponding intrinsic value per share of this particular company? So as you can see in this 9.46 and 1%, so that is coming at 534, which is near to 571, because my terminal growth rate is same. This weightage average capital, instead of 9.46, I am taking at 10%. So this I am getting this 534. So like that, we can get. So as we can see, as this discounting rate or a weightage average cost of capital that is going up, my value is decreasing. So that is that is the actually we can draw conclusion, which is as per the laid down procedure, as per the laid down procedure. And if my growth rate is going up from 1%, so that is giving me a value, means on upper side. So that is the sensitivity analysis, which is very useful. And then we can make this revenue, we can take this sensitivity analysis in another fashion. So I have taken this revenue figure and the weightage average cost of capital. So all these are means this will give you, this will provide me the sensitivity analysis with reference to another variable. So this is about the financial model, and it is not possible to go through this in a detail. Otherwise, this is a very important topic, how to develop the financial model. So with that, actually, now we will go to my PPT. We will cover the PPT in a remaining time. But before doing that, actually, whatever we have covered so far, So if you have any question on the whatever we have covered so far, so that you are welcome. Your questions are welcome. Actually, I could not see in the chat box, so that is yeah, because there are many messages, so I cannot hear. So that I corrected. I am sorry for that. Actually, I had not seen this audio. So means your messages. So I am sorry for that. And now we can move, as I can see, sir, how is DuPont analysis used in a projection? So DuPont analysis, that is mainly dividing return on equity. So we all are aware about return on equity ratio. So that return on equity, whatever is there, that is actually dividing into three different ratios. So DuPont analysis will help us to arriving at the result of return on equity by a different drivers. So that different drivers, as we can see in the Excel sheet, I will again highlight this Excel sheet. Just give me a minute. So these are three ratios, as we can see. So my return on equity, I am dividing into two parts. What is my net income to revenue percentage? What is my sales to average a total asset? And what is my average a total asset to average AC? So that is divided into a three part only, nothing more than that. So that is means return on equity divided in three stages, three different stages, or four different stages. So that is the usefulness of a DuPont analysis. So apart from that, what data set is there on right that I have already covered. So apart from that, all these are actually means your means all other checkbox messages, it seems, are for your marking the appraisal. So that administration will take care. So any questions? Otherwise, we will go to my PPT. Sir, can you share a video of this online CEP to understand the topic better? So that organizer will be in a position to confirm. So Kajal madam, will you share a recording of this so that that we can do? So that we can do. But from my side, what I assure you, I will share this Excel file to the organizer of this event, my PPT and Excel file. In turn, you all will get that. So that I can confirm to all of you. So apart from that, if any questions are there, otherwise we will move to my PPT. So what I will do, I will go to my PPT. Now time is very less, so we will highlight some. I will actually highlight some important topics. When is a linear projection preferred and when ETS preferred? So, madam, that will depend on the what type of company data we will have. So, FMCG, if we see FMCG, more or less the figures will move in a linear direction. And if we have sufficient number of year, so that will not require any smoothing. So that will move in a similar direction. But other sector, they may require ETS, exponential smoothing. So that will depend on the company which we are doing analysis of. And why GDP is considered without inflation. So that is, sir, the if you go through the guidance provided in the international valuation standard, so that is giving us that is actually for a terminal value. So how you will arrive at the inflation figures of future. So that will not be actually easy to have. So actually for that, your screen is not visible. Yes, I have not shared the screen so far. I am actually giving a replies to the query in the chat box. So normally it is a GDP, sir. That is going by the guidance provided in IVS, International Valuation Standard. But in valuation, no guidance is sacrosanct. You can actually modify that based on actual data which you will have. So I hope that is clear. And any further question? Uh, so if no of any counter question or any further question, otherwise we will go to my PPT. So as I already highlighted, since time is short, so I will take you through the important this thing only. So what is valuation approach? So that income approach, market approach, and a cost approach. These are three approaches. So what is the meaning of approach? We all know. So I will skip this. And these are three approaches. These are the brief about what is market approach, what is income approach, and what is the cost approach. And these are the methods under the income approach. So as we can see, IBS 105, IBS, as we all are aware, divided into two parts. We have general standard, five general standard, IBS 1012, IBS 105, and we have eight general standard, IBS 200 right up to IBS 500. So between IBS 200 to IBS 500, we have eight general standard. And as we all are aware, this IBS is under amendment. So discussion is already on. The IVSC, or International Valuation Standard Committee, they have already published, and that may undergo change. But this IVS 105, as we all are aware, that is for valuation approaches and methods. And if we go as per the guidance provided in IVS 105, so there are two methods: discounted cash flow method and income capitalization method. Indirect reference is there. And if we go to ICAI valuation standard, so in India, as we all are aware, Institute of Chartered Accountants of India, they have published the valuation standard. So if we go by 103, we have this method: a discounted cash flow relief from royalty, multi-period excess earning, with and without method. So discounted cash flow is common, but sir, any question? As I can see, name is not there, but Galaxy M31. So do you have any questions, sir? So it seems it was by mistake. This relief from royalty method, multi-period excess earning method, and with and without method, that is not there in IVS. So a question will come, why it is so? So all this method, as we all are aware, that is used for intangible asset, evaluation of intangible asset. And in IVS, these methods are recognized, but that is under the asset standard, IVS 210, which is for intangible asset. So in IVS 210, there are five methods of valuation of intangible asset. So apart from these three methods, we have two other methods, that is distributor method and greenfield method. So these are an option pricing method that is used for valuation of financial derivative option contract, but that can also be used for evaluation of enterprise, for evaluation of equity whenever there is uncertainty, ESOP and all. So that is about the different methods under the ICAI evaluation standard 103 and IBS 105. And we will start with the year. So that is a para 10.1 to 10.2. So that is a general introduction about the evaluation approaches. So a consideration must be given to the relevant and appropriate evaluation approaches, and one or more evaluation approaches may be used in order to arrive at the value in accordance with the basis of value. So we have three approaches: market, income, and a cost. So a question will come, which approach is used most? So going by the findings of a recent survey, around 70 to 80%, it is a market approach, because market approach will give us the value of a recently concluded transaction, and the value which is stabilized in the market will always have an upper end. So in a majority of the cases, the market approach is used as the primary basis of valuation, and as a secondary basis of valuation, income approach is used. So that is what is highlighted. One or more approaches, and three approaches described and defined below. These are the main approaches used in evaluation, and they are based on economic principle of price equilibrium, anticipation of benefit, and substitution. So we all have learned about these three economic principle, fundamental economic principle during our student age. So this is very important. These three approaches are based on these three fundamental economic principle, which is a price equilibrium, anticipation of benefit, or a substitution. So what is the meaning of price equilibrium, anticipation of benefits, and a substitution? So we will actually revise that. So that is here. Means these highlights that a different evaluation method are rooted in a fundamental economic principle. So what we are doing a day in and day out, that is based on fundamental economic principle. So what is price equilibrium? We all learned during our student age. So price equilibrium refers to the idea that price of an asset or a good that is determined by the forces of supply and demand in the market, and evaluation method that are based on this principle like market aim to estimate the fair market value of an asset based on how similar assets are priced in the market. So that is what our market approach is. Market approach is based on our fundamental.
जुमला जी लड़की जो है ना, लड़की के दिमाग में आ जाती है कि तेरा ठीक है वहां होएगा, 2 महीने 3 महीने बाद हो जाए, फिर बोले और किसे मैं करूं तो फिर वहां
God sir, may I request please?
बच्ची का इतनी अटैचमेंट हो जाएगी तो हो ही जाएगा, फिर बच्ची का अटैचमेंट हो जाएगी तो लड़की कभी होएगी ऐसे.
Thank you. I will again request all participants, please mute whenever you are not talking. So a price equilibrium, we all learned about that in our student age. That is one of the fundamental equity principle, and market approach is based on this fundamental equity principle of price equilibrium. So that is our market approach. What is income approach? So that is based on another economic fundamental principle, that is anticipation of benefit. So anticipation of benefit that refers to the idea that an asset is valuable because it can generate a future cash flow or a benefit. So in any evaluation assignment, when we are doing through the income approach, it is very important to arrive at the conclusion that whether that asset is capable of generating the future cash flow. If that asset is capable to generate the future cash flow, then only we can do valuation going by the income approach. Otherwise, it will not be feasible. So that is a asset is valuable because it can generate the future cash flow or a benefit. And a valuation method that are based on this principle, like the discounted cash flow method, that will attempt to estimate the present value of assets, a future cash flow, considering a time value of money and a risk associated with those cash flow. So that is our anticipation of benefit economic fundamental principle. Then we have this third approach, which is a substitution. So substitution is nothing but our cost approach. So substitution refers to the idea that asset is worth no more than the cost of obtaining a substitute asset that will provide the same benefit. And evaluation methods that are based on this principle, like cost approach, will attempt to estimate the value of an asset by determining the cost of replacing or reproducing the asset, considering depreciation and obsolescence. So what I wanted to highlight, what approaches we are actually considering today that are based on the economic fundamental principle that we learned during our childhood, during our student age, the price equilibrium, anticipation of benefit, and a substitution. So that is our three approaches, and we will skip that when actually income approach is used. But first, I would like to take you through this survey, findings of a survey, which will help us in our practical assignment, and then we will go through this entire PPT, where whatever is feasible in remaining a time. So this particular survey, this was conducted by the National Stock Exchange and EY in 2021. So actually every 2 years they conduct the survey, and you can look out for 2023 survey, which they may conduct in near future. So that will give us a very good insight about how to make a projection in income approach. So that will give us a very good insight. And this survey is a survey document that is freely available on the internet. You can download that as per your requirement. The name of survey is a cost of capital survey, India Insight. So this is with a particular reference to India. And apart from this, there are many other entities who are conducting this type of survey, and these are available on internet. Some of the survey may be of the year 2023, and that will always provide us a very good insight about what actually is happening in the market. So this is a cost of capital survey, India Insight 2021, conducted by NSC and EY. There I have taken I have taken this topic, how to estimate the cost of equity. So cost of equity in a DCF, as we all are aware, that is a very good, very important variable. Most companies that is greater than 50% in India prefer using an organization a specific hurdle rate as their cost of capital, which is against the guidance provided in evaluation standard, but still it is happening. Organization a specific hurdle rate, that is nothing but which we use in our capital budgeting decision. So in our capital budgeting decision, each company individually will actually specify a certain hurdle rate based on which they will decide whether to accept a project or not. But that is good for the selection of capital project. That will not good for the evaluation that whatever a cost of equity is there, that should not be company specific, that needs to be market specific. So that is most companies greater than 50% prefer using organization a specific hurdle rate as their cost of capital, and a little over one third of the respondent indicated that they use a CAPM, capital asset pricing model approach, which is in a contrast to the developed market of US and Europe, where application of CAPM in a discount rate estimation is much more widespread. So in India, 33, one third percent, they are going by the CAPM. But as is highlighted here, in a developed country like USA and European country, the CAPM is used most widely, and that is actually giving us a very good measure to arrive at the cost of equity. So means we have come across two methods of the cost of equity. One is organization specific hurdle rate, another is a CAPM. So which is the third method? So given the volatility seen in equity market in the recent time, a trend observed in the previous survey of using bank lending rate with necessary adjustment continues to be a preferred benchmark for a cost of capital for nearly 20% of the respondent. So that is the third method of arriving at the cost of equity, which is build-up method. So build-up method, they are starting with the bank rate, prevailing bank lending rate, and they are making adjustment to arrive at the cost of equity for a particular company. So this is the third method. And use of bank lending rate as the starting point for a discount rate estimation that was observed predominantly in FMCG, consulting, healthcare, chemical, and retail sale. So that is about the cost of equity survey. I hope that is important, and we will go through the finding of this survey in more detail. But prior to that, as I can see, it is more than 90 minutes now since we started. So can we have a short break of 3 to 4 minutes if it is convenient to each one of you? It is always good to have a walk after sitting for more than 1.5 hours for a relaxation. So can we have a break of 3 to 4 minutes? As I can see, Sarma sir is there. So Sarma sir, can we take a break
Yes,
of
sir. Namaskar, sir.
Namaskar, sir. Namaskar.
How are you, sir?
I'm fine. I'm fine. Thank you, sir. So can we have a break of 3 to 4 minutes? So it
Yes, sir.
is
Yes, sir.
11:35, and we will resume the session at 11:39 sharp. So thank you for your attention throughout this session and making it interactive.
ठीक है कितने तो दस भी ऊपर दे देंगे तो टेंपरेचर के ऊपर कौन है प्लस ये जड़ा पोर्शन है और भी डाउन है थल्ले फिर भी कोई इतना अनकंफर्टेबल नहीं
So can we resume the session now? I hope each one of you have rejoined. So we will start from where we left. Let me share my PPT. I hope my PPT is visible. So that's it. That is means we have gone through the cost of equity. Now, what company specific factors are used to adjust the cost of equity? So as we all are aware, we have we have actually already spoken about the beta and alpha measure. So that is what is highlighted here. So as per a CAPM theory, a discount rate estimation, the risk that companies are faced with, that can broadly be put into two buckets: systematic risk and unsystematic risk. So a systematic risk of a company these are dependent on the risk of overall market or industry, and that can be eliminated by a diversification of investment. However, the unsystematic risk, these are specific to the company and not based on a factor that affect the overall market or even the industry. So therefore, unsystematic risk cannot be eliminated by a diversification. So as we all are aware, two types of risk, a systematic risk and unsystematic risk. Measure of systematic risk is a beta. Measure of unsystematic risk is alpha. Beta is market specific. Alpha is individual, company specific. And that, as we all are aware, this valuation estimation we are doing by a two factor, a quantitative factor and a qualitative factor. So quantitative factor we can do by actually analysis of the financial statement, but it is always challenging to arrive at the means qualitative factor analysis of the qualitative factor, because what qualitative factor will involve is the who are the promoters of the company, who are the customers of the company, how is the morale of the company employee, who are the supplier of the company, what is the location of the company, how old the operational facilities of the company is, how good the infrastructure of the company is. So all these are very judgmental, subjective, and that will be part of the unsystematic risk that will be a company specific, and that can be a measure of that is alpha. So that is what is highlighted here. So unsystematic risks are specific to the company and not based on a factor that affect the overall market or even the industry. Therefore, unsystematic risk cannot be eliminated by a diversification. You cannot change the promoters of a company. You cannot change the location of a company. And location will always be very helpful. If we take one example, so as you can see, most of the public sector oil refinery, that is inland in actually means a location like Mathura or Panipat and all. So these are inland refinery, and what is the input of a petroleum refinery? That is crude oil, and we import around 85% of the crude oil. So most of the crude oil, which is raw material for a refinery, that is imported. And if it is inland, so you will appreciate that will increase the transportation cost, and finished goods against that will be distributed to the countrywide, because the refinery production will be very huge. So that distribution will take the countrywide and even export also. So if a refinery is on a coastal belt, so that will be very helpful. That will reduce the transportation cost on both inputs and outputs of the refinery. That is the reason, as you may be aware, this Reliance refinery or SR refinery, that is located on a coastal location of the Gujarat, Jamnagar. So that will always play a very important role. So like that, there can be many factors which we need to take into account. I have given just one example. So that you cannot change by a diversification, location of entire refinery, how you will change. So that is what is highlighted here. So while systematic risk, these are represented by beta, which is part of a discount rate estimation as per CAPM. Unsystematic risks are represented by alpha. And there are various factors that could necessitate an alpha adjustment to the cost of capital. And a respondent identify a company project specific risk perceived at the time of evaluation as the biggest factor, followed by uncertainty stemming from a conservativeness or aggressiveness in a projection used for the analysis. So that is the alpha estimate. These are the company specific factor. And how do you use a DCF technique to evaluate the investment opportunity? So when as we already discussed, there are three approaches: market, income, and cost. So which approach is used the most? So about 62% of the respondent consider the DCF method in combination with other method like a peer company multiple. So peer company multiple is nothing but your market approach. and transaction multiple. So that is your market approach. So only 20% of the respondent use DCF analysis as the primary basis for making the investment decision. So in other words, market approach is used most, as we already discussed. So these proportions are in line with the trend observed in a 17th survey, and that reiterate that combination of forward-looking scientific approach like DCF along with empirical and relative market-based approaches are seen to work best with a finance professional. So primarily, we should go by the market approach as far as possible. And when it is not possible to go by the income approach, market approach, then we can use the income approach as a primary basis. As is evident here, only 20% these are doing a valuation estimation going by the market approach. Oh, sorry, income approach. That is the important finding. And this is the typical forecast period. So as we all are aware, the DCF is divided into two parts. We have explicit period and we have the terminal value beyond the explicit period. So a majority of the cases, it is a 5%, a 5-year. Explicit period is a 5-year because it is not feasible to make projection beyond a period of 5 years. And if we go by the guidance provided in IFRS 13, that is International Financial Reporting Standard 13, or in INDES 113, which these both standards are on measurement of fair value. So there also it is recommended to have a 5-year explicit period. So what are the findings? So this survey, so evaluation using the DCF approach, that will involve two components: a value of cash flow for the explicit forecast period and a terminal value of the cash flow. So explicit period is a period for which reasonably detailed forecast can be prepared. So more than half of the respondents showed a clear preference for considering explicit forecast period of 5 years. So a majority of them are going with a 5-year period, and that is what we should do. And means 5 years for a DCF analysis before applying the terminal value. And of the remaining respondent, an equal proportion of around 20% each showed a preference for a 3-year and a 10-year, while the remaining for other. So companies that make up for other category would primarily be those that evaluate finite-lived project, fixed period project, and use the actual remaining project life as the forecast horizon. So a preference for a 5-year forecast period by the majority of the respondent indicates that they typically consider this to be the period for which a reliable estimate can be prepared with a reasonable basis. So normally explicit period in a DCF that needs to be 5 years, but there are other findings also that can be reduced to 3 years, or that can be expanded to 10 years depending upon the inputs available for a particular assignment, and for a finite lived project, like wherever a project life is fixed. So supposing it is relating to a valuation of a this windmill project. So life of windmill is fixed. So 20-year, 22-year. So we can have explicit a period even more than 10 years. So that will depend upon a project to a project or each assignment of evaluation. And this is again a very important terminal value, as we already discussed. Terminal value is around 70 to 80%. So very important in a DCF. So a terminal value, that is estimate of potential value that can be generated by the company or a project once it operates at stable levels perpetually. So in most companies, a terminal or a perpetuity value that accounts for a large part of the overall company value. And of the two most widely adopted approaches to estimating the terminal value, more survey respondents use the Gordon growth perpetuity model, or stable rate growth rate model, stable rate growth rate model, or the Gordon growth perpetuity model. So that is widely used, Gordon growth perpetuity model. Then the exit multiple method. So exit multiple method, that is based on the market approach. So in income approach, we are mixing two approaches, income and exit. So as far as possible, we may avoid exit multiple method, but particularly in evaluation of startups, when we are doing by a DCF, so there actually the use of exit multiple that is a widespread. So that will again depend upon assignment to assignment. So a more survey respondent use Gordon growth perpetuity model, then the exit multiple method, while about 1/10 of the respondent indicated using a combination of two. So majority are going by Gordon growth perpetuity model, and some others are using exit method, and some are using combination of the two. So a respondent in sector like infrastructure, power and utility and renewable, they indicated since most projects are a finite live, so no terminal value is considered, while some of the respondent added that they use the asset valuation or a salvage value of asset to arrive at the terminal value. So that is about the terminal value. And this is about the terminal growth rate. So we discussed that in our Excel also. Very important, a terminal growth rate. So a terminal growth, that is the long-term stable growth at which a company estimate to grow beyond the explicit forecast period. An average long-term stable growth rate for Indian businesses, as suggested by the respondent to this particular survey, that is approximately a 4%. So that is the we have seen that 5.5% average GDP growth, and this majority of the respondent to this survey, they are taking the terminal growth rate of 4%, because you cannot expect a company to achieve a growth beyond the growth rate of the economy in perpetuity. So short term, a company may achieve a growth rate higher than the growth rate of the economy as a whole, but in a long term, particularly a company which is expected to function as a going concern in a perpetuity in unforeseeable period, so they can progress only at they can progress not about the rate of GDP growth in a perpetuity. So average long-term stable growth rate for Indian businesses as suggested by the respondent, that is approximately 4%, and this is lower than the 4.5% or average observed in 2017 edition of the survey. So that is about the terminal growth rate. And I wanted to highlight this first because we have less time. And now in a remaining time, what I will do, I will take you through some important slide, because it is not feasible to go through the entire survey in a remaining time now. So I would highlight this. According to me, this scenario analysis and a sensitivity analysis, that is a very important in a DCF. So what is scenario analysis? So that is a key component of financial modeling that will involve creating a multiple scenario to simulate a different economic and financial condition and assess the impact on a company's financial performance. So as we have seen, normally actually these three scenarios are taken: a base case, then upside and a downside. So it is always better to have estimation under the DCF or under the income approach in three different scenarios. So the goal of scenario analysis, that is to provide a comprehensive view of the potential outcome of a financial model and to help company to make informed decision in an uncertain environment. And a scenario analysis is a valuable tool in a financial modeling, as that will allow companies to consider a range of potential outcome and to make a decision based on the most likely scenario. So that will also help company to identify a potential risk and opportunities and to make a contingency plan in the event of unforeseen circumstances. So that is a very important for the valuer, and these are the steps involved in scenario analysis. So first it will start with defining the scenario or identifying the key driver of the company's financial performance, like sales growth, operating expenses, interest rate, exchange rate, wherever export or imports are involved, and defining a different scenario based on a different assumptions for these drivers. So it will start with identification of the key driver, and then developing a financial model for each scenario. So creating a financial model for each scenario, taking into account assumption for a key driver and their impact on a company's financial performance. And then projecting the financial result, that is the third. So each scenario of what is the revenue, what is the expenses, and what are the cash flow that will be projected, and then analyzing the result. So that is the next step, and comparing the result for each scenario and analyzing impact of the different assumption on a company's financial performance. And then finally, it is making the informed decision. So these are the key steps which are involved in a scenario analysis. Then we have this sensitivity analysis, again, a very important. So that is a crucial part of a financial modeling for evaluation, as that will help to assess the impact of changes in a key variable on the result of the model. And a goal of sensitivity analysis, that is to identify the key drivers of the company. So in our Excel, as we have seen, we have taken the weightage average cost of capital, we have taken the terminal growth rate, we have taken the growth in revenue as the key driver. So depending upon each assignment, we can identify the key driver to make the sensitivity analysis. That is very important. And a goal of sensitivity analysis is to identify the key drivers of companies' financial performance and to understand how changes in these drivers impact the evaluation of the company. So this sensitivity analysis, that is a valuable tool in a financial modeling for evaluation, as that will allow a company to understand the impact of changes in a key variable on the evaluation of the company. So that is the sensitivity analysis. And these are the steps involved in a sensitivity analysis. So identification of the key variable, that is very important in both a scenario and a sensitivity analysis. So that can be sales growth, operating expenses, interest rate, exchange rate, etc. Then creating a base case, then a varying key variable, analyzing result, and this. So that is the sensitivity analysis. And these are the advantages of the DCF method. It is a future oriented because we are making a projection related to a future. So we are not taking only historical results into a consideration. We are taking the possibility of generation of future cash flow also in a DCF technique. So that is the advantage, a future oriented. Then we have the flexibility. So this DCF model can be customized to a specific company or industry, and that can incorporate a range of assumption and a scenario. And the precision, so that model will allow for a precise calculation of a company's intrinsic value based on a discounted future cash flow. Then we have transparency, whatever assumption we are making, that can be reflected in the financial model. And these comparison, so for the purpose of comparison also, this will be very useful. And so different companies and industry, as they use standardized method for evaluation. So these are the disadvantages. Uncertainty, that is the most disadvantage, because nobody can predict the future in this uncertain time. Tomorrow, what will happen? Whether we will have a flood, or whether we will have a war-like situation. Nobody can predict in this most uncertain world. The uncertainty in projection, that is the most or foremost disadvantage of a DCF model. So these rely on projection of future cash flow, which are inherently uncertain and subject to change. Then sensitivity, so these are highly sensitive to the assumption used in evaluation, like growth rate, discount rate, terminal value calculation. So as we already discussed, even a minor change in a growth rate or a discount rate or the terminal value, that can make a very huge a very huge difference in a final estimation. It is very complex also. Market approach is comparatively easy because you are getting some ready-made multiple. But here, actually, you need to make all type of assumption. So that will create your judgment sensitivity. So it is complex, limited scope, and it is not free from a bias. So that is about the disadvantages. And in this limited time, so it is over from my side. So in a 2 hour, as you all will appreciate, it is not easy to discuss a subject like income approach. But within that limited time, I tried my level best to provide you as much input as possible. I hope that will be useful to each one of you. And I thank each one of you for your attention on this Sunday and making this session very interactive. So I express my sincere thanks for that. And before we finally conclude, any questions from your side? So as I can just so can we use different financial model for a different scenario of the same company? If yes, please explain. Can we use the so there are different types of financial model. So I will again take you to my PPT, but depending upon which type of transaction is taking place, we can make use of different financial model. So just a minute. So I will take you to the relevant portion. I have incorporated this in my PPT, and I will forward this PPT through the organizer of this event. And you will get this information about the financial model. So So as you can see, what is the use of financial model in valuation? So these are mathematical tool used to analyze forecast and financial performance. So that is use of financial model. And I have also given this meaning of financial model. So that I would like to highlight financial model are only as good as their input and assumption, and should be used in conjunction with other tools and a method to make informed decision. And this is the importance of financial models in evaluation. And these are the types of common financial model which are used. So we have pre-statement model, a discounted cash flow model, merger model, initial public offering IPO model, leverage buyout model. Leverage buyout, as we all are aware, a majority of the funds are arranged through debt instead of equity. Then some of the parts model which is used particularly in a conglomerate company or a company having various types of business, or wherever we are doing valuation of principal and subsidiary company. So some of the parts model, then we have liquidation value model. So that is used in when a company is under a winding up process. Then a comparable company analysis model, a precedent transaction analysis model, option pricing model. So these all are different types of financial model, and we can make use of that different types of financial model depending upon a requirement. So I hope, madam, that will reply to your query and any further question. And I really thank each one of you. So as I can see through chat box, you have blessed me. You have expressed your blessing to me, and I am really thankful for your kind words.
Thank you, sir.
Thank you very much for your kind words.
Thank you, sir.
Thank you for your kind words. So, any
Thank you, sir.
thank you,
Oh,
Sajid. Thank you very
shall
much.
we close, sir? Shall we?
Yeah. If no question, then we will close, sir.
Yes. So we have come to the end of this CEP. I thank Speaker Yogesh Chetwani, sir, for taking this session and explaining all aspects of the topic very nicely. Participants are aware that valuation report is being looked into more discreetly by the stakeholders. So IBBI wants and all stakeholders want that the approaches or standard, whatever being applied by the valuer in the valuation report should be clearly mentioned. Thank you very much, participants, for participating. And please share your feedback. Thank you, Kajal. Thank you. Thank you, madam.
Thank you, sir.
Thank you. Thank you, everyone.